It's midnight, you're scrolling through real estate listings, and the mental math is starting to feel like a fever dream. Every house that isn't a total teardown costs $500,000. For that price, you're getting laminate countertops from 2003 and cabinets that have seen better decades. Then there's the basement, dark wood paneling and beige carpet. Yet the listing agent has the audacity to call this a starter home. This scale shows the gap between the median U.S. household income and the current cost of entry. We are asking families making $84,000 to buy houses that cost 6 times their annual salary. Everyone from your mortgage broker to TikTok influencers says it's doable, but qualifying for a loan and actually being able to sleep at night are two very different things. A 20% down payment on a $500,000 house is $100,000 in cash. The median American savings account holds about $8,000. That leaves a $92,000 gap. Most people bridge that gap by putting down 5 or 10%, which immediately triggers private mortgage insurance. PMI is effectively a poverty tax, a monthly fee you pay to protect the bank because you weren't wealthy enough to meet the 20% threshold. With 10% down, your base principal and interest payment drops in at $2,850. Now we stack hidden costs. Taxes add $500. Skyrocketing insurance adds $300. Maintenance adds $417. And PMI tax on $300. To keep the lights on, you are looking at $4,367 every single month. Standard financial advice often ignores the sheer weight of these carry costs, locking buyers into a financial stress simulator that leaves no room for error. Most advisors say you shouldn't spend more than 28% of your gross income on housing. If we work backward from that rule, we can see exactly who is actually invited to this market. This income distribution shows that a household needs to earn roughly $187,000 a year to safely afford that monthly payment. Only the top 10 to 20% of households reach that mark, leaving 80% of the country mathematically priced out. Consider a couple earning a combined $160,000. They are squarely in the upper middle class and should be comfortable. After taxes, they take home about $9,500. But once you subtract the mortgage, car payments, insurance, student loans, and groceries, that pie chart disappears. They are left with a tiny sliver of cash for everything else. When the car needs new brakes or the HVAC system fails, there is no cash left to cover it. Because they are spending nearly half their take-home pay on the house, every minor repair becomes a high-interest credit card debt. We have rebranded this level of financial desperation as standard adulting, pretending that living one emergency away from disaster is just part of the homeownership journey. This graph shows a housing market that has completely detached from reality. Since 1990, home prices have surged 400%, while wages have only grown by about 180%. Previous generations bought homes that cost 3 times their salary. Today, buyers are being told that 6 times their income is the new normal. The industry has no incentive to warn you. Banks, realtors, and insurance companies profit when the deal closes, not when you manage to keep your head above water 10 years later. The common refrain is that renting is throwing money away, but taking on a mortgage you can't realistically sustain carries far worse consequences than a monthly rent check. The housing math is structurally broken, and the system is designed to get you into the house, not to ensure you can afford to live in it. True wealth comes from having margin in your monthly budget, not home equity you can't touch without selling the roof over your head. There is a profound value in sleeping deeply because you aren't terrified of the next property tax assessment or a sudden medical bill. If your income doesn't support the brutal math of a $500,000 home, you have permission to walk away from the search. You can choose to rent and aggressively invest, look for cheaper markets, or simply wait for a correction. Declining to participate in an unsustainable market is a strategic financial decision, not a personal failure. Success means making decisions based on math rather than social pressure. If the numbers say you'll be house poor, the smartest move is recognizing that the game is rigged and choosing not to play.